Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Hey, welcome back to Big Money Real Estate. I'm Elise Glink. Here's your daily update. Dan Goldstein is the real estate reporter for MarketWatch. He's back on the show today to talk about his 10 tips for tax season. And for those of you who waited until the very last minute or managed to get an extension to file your taxes this year, have we got news for you. Hey, Dan, welcome back.
Hey, thanks for having me.
All right, so as we're taping this, it is just a few, not even days, are left before taxes are due. I guess a few days are left. We want people to understand, if they're homeowners, what are the tax opportunities? So what have you got on your list of top 10 things that you can do to help your tax situation if you're a homeowner?
Well, Elise, I think pretty much everybody knows about the mortgage interest deduction, and that is the biggest one. Half of Americans take that every year, and it adds up to about a $65 billion return back to the taxpayer for what they might otherwise pay the government. And that's probably the most important one, and the only reason why the other half don't take it is because they bought the home too late in the year, and the mortgage deduction is just simply so small that the standard deduction is better. Or the other fact is that if you don't have a mortgage and you own your home, you don't really need to take it. But that's the biggest one. But
wait, Dan, but not everybody can actually take the mortgage interest deduction. I mean, there's about 75% of Americans who will not be eligible, either because, to your point, the mortgage is already paid off, or they don't actually have enough of a deduction to overcome the standard deduction they're allowed to take, or they make too much money, right?
Well, right. You can write off up to 1.1 million worth of debt. So you can actually write that up. Even a home equity loan up to $100,000 can qualify. And the key thing really here is that you really have to know what you can take. And the mortgage interest is just another one. But almost all the interest and all the costs you have to deal with when it comes to having a home loan is tax deductible. For example, let's take points. You can often write off the points. You may not be able to write them off, say, in 1 year, but you can write them off over the course of the loan, whether it's you have to amortize them or you take them all up front. But you can get it whether it's a discount point or it's prepaid. The way the IRS looks at that, it says that's prepaid interest and you can deduct it.
So we've got points on a home mortgage or refinancing. The points when you buy your house, deductible in the year of purchase. If you refinance, you can take it out over time. You've got the interest on a home improvement loan up to $100,000. You've got property taxes that are deductible, right?
Yeah, absolutely. And property taxes are another one people do miss. You can probably take almost always take your property taxes. The one thing that I would advise people is that a lot of the things that you see on your HUD-1, on your settlement statement, that might look like taxes aren't necessarily tax deductible. That being said, if it looks like a tax and it sounds like a tax and it smells like a tax, you can probably write it off. I would just check with your advisor about that. The only thing is, of course, is most of these settlement fees, though, are not tax deductible, like your attorney's fees, like your title fees, things like that. If those are fees, they're not taxes, but
right.
There's plenty of other things that you can write off as well.
Now, we've got on your list of the top 10 things that you should know if you're a homeowner about taxes, you've got the energy efficiency tax credit and the renewable energy tax credit. I always like tax credits rather than deductions because it's a dollar for dollar reduction of the actual tax you pay versus a deduction, which kind of might be 20% of what you've actually paid. How many people are actually still eligible to take energy efficiency tax credits or renewable energy tax credits?
Well, the thing is right now, if you do these things such as install energy efficient windows, all these kind of things that help you save money and save energy. In fact, even if you put solar panels on your roof or even do a little generation windmill on top of your roof, you can actually write a lot of that off, and you can actually get a $500 credit for a lot of these energy efficient projects. And then for the bigger, more capital intensive stuff that we talked about, like a windmill, you can take up to 30% of the cost, which is very generous. The key thing is they are both going away in the next 2 years. So you have up until the end of December 2016 for both of them. So if you haven't done it this year, you can certainly take it in the next 2 years.
Right, you want to do it. Number 6 on your list, which I thought was a good one, is ground rent, or really it's a ground lease. There are, especially in manufactured home communities, the owner owns the land, and you rent the land even though you own the house that it sits on, even if it's permanently affixed to the property. You see this a lot going on in England, Great Britain, where the Crown often will own the land and you've got a 99-year lease on it, and that ground rent, to your point, is deductible?
Absolutely. And, another place where we see that happening, there's certainly a lot of places in Baltimore, where I am in Baltimore County, that have ground rent. And another place that they have in the United States is Hawaii, where, just like you said, the royal family or the heirs of the royal family in Hawaii actually own quite a land in Hawaii. So, like you said, just
really?
like
do they
Britain,
still own it?
Lease it?
I didn't realize that the heirs still own it. That's great.
You've got to lease it. You've got to lease it from, maybe not from them, but from their heirs. So
from somebody else. Okay.
That's right. That's right. But the IRS says that if you do pay that ground rent in either a monthly installment or annually, you can write that off. The only catch is that if you capitalize that ground rent so that you can get out from under it and you don't have to pay it again, that one-time payment is not tax deductible.
Now, I thought your number 7 was interesting, and this I didn't quite understand how this might work. You've got the income and the interest paid on reverse mortgages. So the concept with reverse mortgages is that you don't pay anything until you actually sell the home. How does it work in terms of your taxes?
Well, the IRS looks at the reverse mortgage as a loan to yourself and not income. So that in itself is not it's not counted as income, but the interest that accrues as you take down that mortgage can be written off. Of course, as it says, you can't do it every year. It's only when you actually you pay that off. So you can only take it one time, but you should be aware that if you actually do pay off that reverse mortgage, you can take the interest deduction that year. That's
sort of interesting. It would be really interesting to talk to a tax accountant about that, because typically reverse mortgages are sold when people move permanently from the house or they die and then they sell it. And that's how that reverse mortgage gets paid off. So it'd be really interesting to see that in practice. And if there's anybody out there who's actually done this, we have a bunch of tax preparers who follow us. If you've actually done that, please email me. I would love to know it at questions@thinklink.com. All right, quickly, number 8 on your list is private mortgage insurance. Now, this was something that wasn't supposed to be deductible, but there was a rule that went into play that made it deductible, but I thought that rule came off. Is PMI still deductible?
Well, we've got one more year. If you haven't taken it in 2014, this is your last year to take it, because it goes away at the end of the year. So this is basically it for PMI. The good news is we've probably all seen that PMI rates are going down going forward. But when it comes to interest, taking off that interest, this is it. Or excuse me, taking off that deduction for PMI mortgage, this is the last year.
All right. And then you've got home expenses and improvements. What do you mean by that?
Well, obviously you can't write off home improvements and expenses, but what you can do is add them to the cost basis of your home when you do sell it. So what that does is if you add that obviously onto the asking price or to the cost basis, you then narrow obviously your profits and your capital gains, and then you actually hopefully will have a smaller capital gains bill at the end of the year.
Let me be super clear, though, for anybody who's watching this. You can't take painting expenses. Like, you're repainting your house, that's not going to count. We're talking about major structural capital improvements. You need a new roof, hot water here, you have to replumb the house. Those are the kinds of improvements that are actually going to be able to be added to the basis, not, oh, my daughter wanted a pink bedroom or a blue bedroom. That's not going to work.
That's right. And that's not going to do it. And I think right now, as we've gone back and seen, is if you can't pay Joe Contractor, you can't write off what you pay Joe Contractor for that. But the interest, if you get a loan to pay him, you can obviously use that interest, and as a lot of people do, and it doesn't matter whether you use a home equity loan or a home equity line of credit, a HELOC, you can still take that interest up to $100,000.
And I just want to be really clear again. Just because you do the work doesn't mean you could write that off as part of the cost. That doesn't work that way. You actually have to hire somebody else to have that be as part of the expense. You do it yourself, but the IRS doesn't give you any bonus for that.
Absolutely, but the important thing is no matter what you do, document. You got to keep your receipts. You got to be able to show exactly what you did and how much it cost.
Right, which I think is a great point. And then finally, you've got first-time home buyers. I assume what you're talking about here when they're buying, it's writing off the points, but is there something else that they've got to think about?
Well, I mean, obviously we've talked about the points, and the important thing is why the home interest, the home mortgage deduction is so important, because when you're that first time buyer, your first few months or your first few years are going to be interest payments only. So even if you can't take that mortgage deduction in that first year because you bought it in at the end of the calendar year, and as we talked about with the standard deduction might be higher than if you took the mortgage deduction and itemized, you're probably going to be really well off if you can take that mortgage interest deduction the following year. So you can write off as much interest as you get for that first loan, and even if you have a second loan, like right. If you have a home equity loan, maybe you had an 80-20 split from back in the day.
Right. Let's hope not. Those didn't work out so well for a lot of people.
No, they didn't.
Dan, thank you so much for being with us. Dan Goldstein's the real estate reporter for MarketWatch, and we'll talk to you again soon for sure.
Thank you for having me again.
All right, and thank you for watching this episode of Big Money Real Estate. Send me your real estate and tax questions on Twitter and Facebook. We'll be sure to share the answers with you. And then you go and share this video with all your social media. Until next time, I'm Elise Glink.